Hello, everybody. It's Tom Sheridan and Chris Darbyshire from 7IM. A couple of weeks ago, we came out with the Q4 Asset Allocation Committee meeting minutes, and we told you what we were doing in the portfolios, and promptly the world turned upside down on us. We thought it might be a good idea to communicate what we saw in that world turning upside down, and in fact, what we're doing about it in the portfolios. Chris, can we remind people, first of all, that a couple of years ago, we postured that we were entering a new normal. And the new normal was going to be characterized by lower growth, choppiness in markets, but a continuing upward bias in equity markets. What have we had?
Well, I think we've had less volatility than we thought. So markets, I think, have been progressively less choppy as time has gone by, which has been a surprise. We've certainly had lower growth. We've certainly had low growth, negative growth in earnings in some developed markets. But we have had, on the whole, market-wise, we've had an upward bias.
May be interesting for our clients and our intermediaries to know that in each of the last 5 years, the FTSE has had over a 10% drop. So in 10, 11, 12, 13, and now in 14, this is getting to be an annual event. And in a world where everybody's looking for that big inflection point where the world really, really turns around, and what many people want to know is, have we just seen it, or are we in the midst of seeing it? And your thoughts are?
I think this is a market move, not an inflection point in the world beyond the market.
Okay, so not a radical reposturing from what we said only a month ago.
Correct. Economically, things very much the same. We had disappointment in Europe a month ago. Still have disappointment in Europe, perhaps a little bit worse, to be fair. But the US is strong and the recovery is still on track there. The UK recovery is still on track.
People worried about China.
I think China has really been a big positive this year. The bears on China were worried about a hard landing where some of the credit problems in China, the excessive lending, the housing market caused social stresses or other kinds of economic stresses that would send the markets down. But actually, the Chinese government seems to have stabilized the economy there, making efforts to stabilize the housing market, and are reflating the economy through loose monetary policy, which we've seen a lot in developed markets as well. So on the whole, I think the bears are losing the argument in China. It's becoming an argument of China moving to a slower growth trajectory, but that's not necessarily a bad thing, and there's no big fear or trigger for a hard landing anymore.
Okay. So I'm trying to find a rationale for what we've seen over the last couple of weeks. Let's go to Europe. Europe is, well, it may deflate. It may drag down the US. It may drag down the UK with it. Is Europe going to pull the plug on the global economy?
So what we have seen over the last few weeks in Europe is we've seen a downgrading of GDP expectations for next year. So I think this year is pretty much done and dusted, so we tend to be looking at next year's GDP growth now. And we've seen European growth expectations fall by about 0.2% over the last few weeks, from 1.5% growth per annum down to 1.3%.
So the IMF seemed to have made a lot of noise and may even have been the trigger for the market correction. Are they seeing something that we're not seeing?
No, I think the IMF is positioned roughly the same way as the majority of market commentators. They've also downgraded their estimates for Europe, but they also see a positive growth trajectory for Europe. So faster growth next year than we've had this year. I think what the IMF warned about, which was significantly different, was they increased their estimate of the probability of a recession in Europe from about 20% to about 40%.
And you don't think that's going to be enough to drag the world down with it?
Shouldn't do. For a start, we're not sure it's entirely justified to go from 20 to 40. Yes, Europe will be slow, but as I just mentioned, most commentators are still expecting faster growth in Europe next year than this year, which is a positive.
Okay. So if we don't think that the catalyst for the big turnaround in the world is China, we don't think that the degree of the increase in the difficulty in Europe is really going to be enough, the next thing we could worry about is higher rates around the world. As the rate cycle goes up, well, you know what can happen if they go up too far, too fast.
I think that's a genuine worry, has been a worry in the markets for a while. What will rising rates do really to market confidence, I think, is where investors are worried. I think they're less worried about the impact on the economy because we know the rate rises, when they come, are going to be fairly mild by historic standards.
Extremely mild, I would think. I mean, we're looking at near zero rates now. Rate rises are apt to be on the order of 25 basis points at a time.
Yes.
Could take us a couple of years to get to 2 or 3%.
And yes, and they may not be going up every month. There may be a rise and then a holding pattern for a while before another rise comes through.
All right, I'm running out of things to get pessimistic about here. Japan, Abenomics was a huge celebration of the turnaround of 20 years worth of deflation in Japan, and we had a big to-do last year. We had a 47% move in the equity markets. We had the yen depreciated, and reality has now set in the aftermath of the VAT increase. Is that all going to come unstuck?
So Abenomics very much is a project still in progress. It will take several years, if not a generation, for Abenomics to really come through. But it's not off track. The initiatives that the government has promised are still ongoing. The actions by the central bank are still ongoing. So it's too early to call Abenomics a failure.
Okay, so there are many things that could possibly go wrong, but then again, what's new? If you look back a year or so ago, we were worried about U.S. double dip. We were worried about German elections. We were worried about Iran. There's always something on the horizon. So keeping our eyes on the many things that could be difficult for markets right now, and bearing in mind what we said only a month ago, have you had any further thoughts on what to do in the portfolios since then?
Yes. So we think, given the fact that the economic environment really is still better than last year, it's come off a bit recently, but nothing like the extent that the market would suggest. We're slowly adding risk in to our portfolios and lifting the elements that anchored the portfolios and provided sort of risk reduction.
And what were the risk-reducing features?
So we had done principally two things to reduce risk. We had maintained a very large unhedged yen and dollar positions.
Right, and can you explain very quickly to our audience how that's a risk mitigation feature?
So these are safe haven currencies. And when the world is going through a mini panic, or markets are going through a mini panic, as we've had over the last 2 weeks, typically, it won't always happen, but typically there's a movement out of sterling and into other currencies such as the dollar and the yen.
And if I remember my math correctly, in a balanced portfolio, over 20% exposure to the dollar and about 8 or 9% exposure to the yen?
That's right, 26% to the dollar, 9% to the yen, imbalanced.
So that's a big, and what have we done since then? Have we changed that at all?
Yes, so over the last few days, we've taken the view, we reran our tactical asset allocation process from the third quarter. So the team sort of reran the valuations work and thought about the scenarios again, decided that our views were not significantly changed. As a result of that, with the market 10% lower, we're beginning to take those positions off. So we've now hedged half of our yen position,
Right.
left the dollar position unhedged for now. We've begun to move money back into the market, so we've moved some money into US small cap a few days ago. We like US small cap because we think it's less affected by the US dollar. Had a bad run over the last 6 months or so.
Had a really bad run, didn't it?
Had a terrible run, so it's sort of underperformed the US larger company market by about 10% over that period.
That's the Russell 2000?
Correct. So we've used the Russell 2000 futures to make that investment. So a very liquid, efficient way to trade.
Okay, so maintaining our equity position, taking off some of the currency risk mitigation now that we've had the 10% drop in markets, and the fixed income asset class, there's been one or two tweaks there as well, yeah?
Yes. So one of the characteristics of the last 2 weeks was equities down, bonds up, and our gilt yields, long maturity gilt yields, are now down around 2.5%, which is their historic lows.
Long yields meaning 20, 30 years?
20, 30-year maturities.
Right.
So we've taken about 1% of that position out of the portfolios.
And what did you put in?
And that was used to fund partly the Russell 2000 US small cap investment, and also to an investment into convertible bonds, where we quite like the sort of equity-linked characteristics there, with the equity markets down 10%.
Okay, so long story short, no major panic, a couple of tweaks to the portfolios, but that is the nature of ongoing and active tactical asset allocation. And indeed, that is why people do business with 7IM and invest with 7IM, because we do try to stay on top of what's going on in the world. We do continually work at the portfolios. The changes that we make are a couple of percent here and a couple of percent there, and steady as we go.
That's right. We don't think this has been a problem with the fundamentals, with economic conditions. We think this has been a problem of the market, of market liquidity. If you think what's sold off, it's been the more liquid parts of the market have sold off. Developed markets have actually sold off more than emerging markets over the last few weeks. So we think this was certain players in the market struggling for liquidity, taking losses in certain parts of their portfolios, which then triggered sales across other parts of their portfolios. Not a fundamentals problem, and therefore we see it more as an opportunity.
Right. Well, thank you very much, Chris. And the continuing saga of the new normal, stay with us as it continues to unfold. Thank you very much, and we'll keep communicating.